Today, it's half a Monday evening property rant. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, unfortunately, Edwin is not available today to have our normal Monday evening property rant conversation. He's still unwell, although hopefully later in the week he'll get better. Edwin, get better soon. Nevertheless, I'm going to take you through some of the analysis that I've done and perhaps link it back to some of the other shows that I've done recently. And thanks to Cookie Boy for some of the clips that he's been sending me. It's a very interesting week of quite significant issues, and we can explore them today. I'm going to start with this one. This is actually a discussion about Joseph Healy and the book that he's just written called What Would Adam Smith Make of Modern Australia? Joseph Healy, of course, is the former Bendigo Bank chief executive. And he basically says that the failure of modern Australia is impoverishing the young and creating the national tragedy of housing. He claims that neoliberalism has, to some extent at least, been bastardized and perhaps would not be really recognized by Adam Smith, the 1770-60 book author, of course, called The Wealth of Nations. And he's arguing that whilst much of the regulation in Australia has been well-intentioned, it's actually really been creating significant pressures. The regulatory environment in this country is a shocker, noting, for example, a cafe in Tasmania that faces and needs to get 31 licenses before it can open. So Smith, he says, would argue for small government, sensible regulation when needed, not suffocating regulation. He also talks about some of the other issues too. For example, the housing market, the regulatory environment for unlocking land for development has been tortuous, he said. And he also advocates a focus on education. And turning to some of the broader issues like green policies, ESG, etc., well, Healy says that perhaps big societal issues as they are should not be filtered through companies. Companies should not be a political platform. And finally, he talks about his issue with regard to sending Australian jobs offshore. When he was at NAB, he said it was done to save costs, but he actually believes that the banking market has been allowed to fall into a state of disrepair. Bankers struggle to read and link balance sheets. He said it's a great example of focusing on what is counted and not what counts. Now, I think there are some really important points that he makes. And of course, I made a show the other day specifically talking about the question of neoliberalism, which I believe has been the seeds of our own destruction. And I agree that neoliberalism has been bastardized, but I also believe that the fundamental assumptions behind neoliberalism are probably not correct. And that takes us quite interestingly on to a discussion about productivity, because according to Commission Chair Daniel Wood of the Productivity Commission, Australians would be $14,000 better off if productivity could be improved. Of course, this was released ahead of the upcoming 3-day Talk Fest, which I have my doubts will not make much difference. Now, this, of course, comes ahead of the 3-day federal government's Talk Fest about productivity, which I don't think will make a lot of difference. But interestingly, this article also refers to the Australian Academy of Science, who actually made the point that R&D in Australia is undercooked. Differences between what's happening with regard to R&D compared to GDP in the US, UK, OECD, China, European Union, Australia. We're right at the bottom of the curve there. Not good. Interestingly, also, there was an article that highlighted that the Albanese government had spent $637 worth of consulting contracts in the past 6 months. That's up more than $100 million on the previous half year. And this article makes the point that the focus on so-called controlling consultants, this is not going at all well. In fact, well, they're spending a whole lot more than they were. Of course, that puts more pressure on the budget. Now, one of the things that is being discussed with regard to productivity is whether we should actually curb trusts, CGT breaks, etc. And there was a round table at Parliament House last Friday where the discussion led to recommending that the government should dial back some of the income tax measures and look to rebalance. The tax system is pushing our most talented individuals away from careers that are rewarded with wage and salary earnings, even if this is where their skills are most valuable. And this is really important for long-term performance of the Australian economy, they said. And they talk about disciplined budget rules on spending are needed to be re-established to limit the need for tax increases. I would lean against the whole concept that taxes need to rise, which is what we hear a bit today, they said. Absolutely. And talking of tax rises, guess what? In the UK, same story. The government there is also talking about wanting to lift taxes. The government borrowed $35 billion more than forecast last month, and the Office of National Statistics said that government borrowings totaled $20.7 billion in June, a significant rise, which leads essentially to higher taxes ahead, despite the fact that in the UK they promised they wouldn't lift the basic taxes higher. They probably will later in the year. Well, big government, ever bigger government, needs ever more taxes. And by the way, while we're looking at the UK, it's worth highlighting that food prices are continuing to rise, adding to another £300 to annual grocery bills. So just like in Australia, inflation is not under control. And also renters face higher bills than mortgage holders because rents have increased. The average rents have increased by £221 to £1,283 per calendar month since 2022, while the average mortgage repayment rose by £218 to £1,154 per month. That's according to data from Zoopla. So, if you're in the rental sector in the UK, as in Australia, you're being taken to the cleaners. No surprise there, I think. And in terms of pressure, another piece of data that came out highlighted the fact that in New South Wales, unemployment continues to rise, and New South Wales lost more than 45,000 jobs in the past 2 months, lifting the number of unemployed in the state over 200,000 for the first time since the COVID lockdowns. But it's interesting, and this is something I see in my surveys, not all regions are actually feeling the same. For example, the Parramatta district, the unemployment rate there is 5.7%. That's the highest of any major statistical area in New South Wales. That was more than double the rate in Sutherland, for example, at 2.3%. And in fact, they go on to highlight the fact that the unemployment rate is at or above 5% across much of Western Sydney, including Blacktown at 5.4%, the southwestern suburbs at 5.4%, and the inner southwest suburbs at 5%. This is all according to ABS data. And yeah, I've certainly been watching this, and there's a strong correlation between rising unemployment, and there's a strong correlation between rising unemployment and, guess what, higher levels of mortgage stress. This next one is really interesting, and Tarek Brooker highlighted this on X the other day. This is data from the Financial Times, and the data shows that across the Anglosphere, home ownership rates have collapsed for younger people, and they've risen significantly for older people. Meanwhile, more and more young people no longer believe that hard work brings success. Yep, we have a problem, Houston. And talking about problems, it was interesting that the RBA, I covered this in a post the other day, and if you want to check that out, it was called The RBA's Messy Day and Why Rate Cuts Might Be Delayed Again. I covered Michelle Bullock's comments, but also the Bulletin article which is covered in the paper here. And they highlight that international students spend twice as much as Australian residents and work fewer hours on average. Not very good productively speaking. They send, of course, a lot of money overseas, which is what I highlighted. And they also make the point that international students add more to demand in the economy than to supply in the short term. In other words, they do stoke property prices. Well. Surprised or not surprised? Not surprised at all. I've been arguing this for some time, but it's interesting that now even the RBA admit it. Although they do hedge it somewhat to say that over time, supply can respond. Well, maybe not. At the moment, we don't see much evidence of supply responding, of course. Now, it's interesting that Christopher Joy actually made a really interesting point in his most recent article and basically called out the RBA for not being very good at its forecasting. They did some analysis and comparative analysis between the central banks in Australia and elsewhere, and they said that comparing the RBA to the European Central Bank and the Federal Reserve, they conclude that the two biggest global central banks generally do a better job of divining future inflation and unemployment outcomes. Yep, the RBA is pretty off the boil when it comes to what is going on. Plus, of course, the RBA was responsible earlier for claiming that rates would stay lower for longer. A lot of people felt rather disillusioned by that when it didn't happen. And now Michelle Bullock is a bit coy about forecasting anything because they might get it wrong. So I think this is a very important factor to bear in mind. Now, the regional, Dale Webster, made a very, very important point in her most recent post, which came out. And of course, the regional is an independent news service for the 37% of Australians in the regions and growing. And she calls out Bendigo Bank for closing a whole raft of agency branches. Bendigo and Adelaide Bank has a continuous assault on its community bank network, forcing the closure of 28 agencies run by community franchises. And this is a very significant and important departure. These are franchises that were set up as an alternative to the traditional branch. Now they're being shut too. So Bendigo says our community partners know that models need to evolve and change as the environment changes and customer preferences change. So here we are back at blaming customers for changing. But the point is that in total, Bendigo Bank has made 22 regional towns now without any banking services. And Dale Webster goes on to talk about each of those in some detail. So check out her particular article there. Talking of banking, it's also interesting that APPA is now talking about changing the regulatory environment. Well, slightly. They're going to introduce a new 3-tier approach, trying to bridge the gap between the new banks who are very small and trying to get started and the larger banks. Of course, what's happened over the last little while is that there's been a massive concentration amongst banking. New players just can't sustain growth, and so effectively they get swallowed up. And what this means is that effectively the APPA regulatory environment has created a very small number of very large organizations who have massive power. We see that, of course, all the time, the market power, whether they're closed branches or whether they charge higher margins in Australia than they perhaps should. So APPA is now at the margins fiddling with this, but I'm not sure it's going to make a massive amount of difference. My point would be that this is more in response to pressure from Treasury, but it's at the margins. And the regulatory environment in Australia is still shot. Bankers, of course, are having a field day. Now let's turn to property and look at one or two of the articles here because there's some quite interesting stuff. Cotality published some analysis showing hotspots centred around some of the catchment areas for some of the schools in Sydney and Melbourne. They're using new custom boundary analysis. And they showed, for example, houses in the catchment area of Killara Heights, Willoughby Girls, and the Linfield Learning Village in Sydney had the most substantial premiums of regions analysed. The median house value was over $1 million more than nearby markets out of the catchments. However, the capital growth trends was lower over the long term. And they also looked at Melbourne too. You can see the heat maps there. Now, here is another piece of data from the housing sector. The particular article here claims that regional house prices have jumped 5.3%. Now, I think that's not the full story. There are some movements up in some areas, but not universally. And here they're focusing in on regional New South Wales house prices, particularly in places like Musselbrook and Singleton up in the Hunter Valley. They also go on to talk about Lismore, of course, Lismore hit by the floods, and Kempsey. Now, I have to say that, sure, these were more affordable areas and still are, but the moves up are not uniformly spread. And again, this is a simplification of what's really going on. Talking of simplification, here's another one. Article here suggesting that maybe granny flats are the answer. Of course, there was some analysis done in October 2023 suggesting there were more than 240,000 properties suitable for granny flats. The regulations were eased back in 2009 to make it easier, and they're suggesting that maybe building a granny flat for kids is actually a way to provide some housing for them. Of course, the question is that really a good strategy? And as I've discussed previously, sometimes these don't necessarily work out very well in the medium to long term in terms of future price value, because they reduce the attractiveness of the property as well in some circumstances. But it's interesting that now granny flats are being spruiked as part of the property affordability solution. Now, talking of solutions to help property, this is another example where properties are being bought up and effectively knocked down to create high-rise solutions, townhouses or something for first-time buyers. Well, we'll see about whether they're for first-time buyers. And I don't think so, given the fact they paid $3.5 million, well above the reserve, for 2 properties here. And talking more broadly about the property market, the most recent auction clearance rates from Domain showed a clearance rate of 72.7% in Sydney this week, up from 70% last week, and in Melbourne at 75.8%, up from 72% last week. But of course, as I always highlight, this is based on the number sold compared to the number of auctions reported, not the number listed. And in fact, the numbers sold aren't that flash. But hey, don't let that get in the way of a good story, because frankly, the story is always the same, isn't it? That effectively, well, you've heard it before. Boom, boom, boom times, and this AFR article highlights this again. It's nearly a record or something. Well, unfortunately, numbers don't lie. Well, they do when they're packaged up, such as the auction clearance rates are. Don't be misled. Now, talking about being misled, I also make the point that the latest super funds reports are out, and guess what? They're claiming that because of the Aussie dollar, the performance is pretty amazing. Although I should caution that these performance figures are for the funds, not necessarily for the individual investors in the funds. And unfortunately, quite often, because of the additional fees, they're not reported in these aggregate numbers. The real returns are quite a lot lower. So it'll be a little cautious about some of this as well. But it makes a good story, I suppose. Strong performance across assets boosted nest eggs in the last financial year. We'll see about that. And finally, before I go, just one last little take. It's this one. This was actually an opinion piece in the Financial Times saying there's a crypto crisis coming. And they talked here about the fact that JP Morgan Chase was looking at lending against client cryptocurrency holdings because, of course, these are not stable assets. Since 2020, Bitcoin, for instance, has nearly been 4 times as volatile as the major indices, yet they're becoming part of the real economy and have the support of the biggest political donors, both Republican and Democrat. US Treasury Scott Bessent has said he expects a tenfold growth in crypto, making it a $2 trillion industry in the next few years. And while the recent passing of the Genius Act is being marked as a measure to make crypto safer, with stable coins backed by US dollars, that won't make a volatile asset class less volatile. Indeed, it may make the whole market more so. And so there's a warning that pro-crypto legislation will not only cause the next financial crisis, but will further fuel US political populism and unrest. And if you're interested in discussing this more, then join me tomorrow with Adam Stokes on my live stream as we unpick the latest in crypto and consider this in the context of the broader economic and political debate. Who is running the show? And what does the emergence of crypto mean? So join me for that. So standing back, 4 points to take away. Firstly, the whole notion of bigger government and productivity are pulling in two different directions. Secondly, the property spruikers are still out there, but of course there's a lot more to tell. And hopefully Edwin will be back to be able to share that later this week or maybe next week. Thirdly, more broadly, there are significant questions around the direction of tax, and that is a big issue which need to be spoken about more than it currently is. And finally, there's a set of big questions around crypto and the trajectory of crypto, and that takes us into a broader discussion about money. What is money? Who's driving that? And the role of central banks. And that's something we'll touch on tomorrow. Anyway, I hope you found this an interesting little nibble, bit of insight into a few things that are going on at the moment. And I look forward to catching up with you again next time. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.